What's up there, boys and girls? This is A Moment with a Real Estate Guy. We are broadcasting live on Twitch and YouTube right now, too. So that's kind of fun. We have Alex Wilson, Jay Ray, both in the lending world. Jay Ray is a lender that I've known for years and years. I think back when I was at Solutions Real Estate, we originally connected, right? That was like 2003 or 4.
For baseline in like Val Vista, yeah.
Yeah.
Is that where you're at? Yeah.
Yeah, Gilbert baseline, so close. Yeah.
Gilbert baseline, there you go. Yeah.
So, and Alex, so Jay, you're a lender, right? Mortgage broker, banker.
Banker.
Okay. So where's your, give us a little spiel about who you work for and all that kind of jazz.
Yeah, I'm with direct mortgage loans. We're kind of a new territory here in Arizona. We're coming up on 2 years now. We're headquartered out of Baltimore, Maryland. But I'm with a group of guys that have been in lending. Names you probably would recognize, like Mike Jones, Kent Nielsen, Aaron Payne, John Crawford. We've got a great branch with it. Just a group of guys that have been in lending, and girls been in lending for 30 plus years together. So, yeah, we are a banker, and we can do everything in house from DSCR to bank statement loans.
Back up a little bit, because some people that are going to watch this aren't going to know those little acronyms. So what's a DSR loan?
It's a debt service release loan,
Okay,
which
okay.
investors can buy a home. It's an investor loan, so you buy a
Okay.
home and you don't need tax returns or anything. We're underwriting basically on the cash flow of the property. So it's a kind of a specialty loan, and investors love it because you're buying a home 20% down. You don't have to give 2 years tax returns and go through the profit and loss hassle and all that. We literally just underwrite based off of the cash flow of the property. So
Sweet. Okay.
much
So
simpler process if you're buying an investment property and you're a seasoned investor. That's usually the way they go.
Okay. So what if you're a brand new investor? Is that something that would appeal to them as well?
Probably not. It's a lot tougher window to fit into. There's really only one investor that in town that I can think of that would take a new investor. Yeah, the lenders want to see that you have experience managing that. So for a first-time person purchasing an investment property, probably not the way to go.
Okay.
Okay. It's gonna be a full doc where we will need 2 years tax returns, etc. Typically.
Gotcha. So now, Alex Wilson, who are you and why are you here today?
Me and Jay are just best friends, so he decided to invite me. No, I work with a group called Hoper and the partner group Attainable Housing Advocates. We have a really cool home buyer incentive program that's been gaining a ton of steam over the last, really outside of our internal partners that we were working with for about a year. So 2 years ago is when that all started. About a year ago, last September, we opened the doors to outside partnerships. I'm a part of that outside sale, I don't know, outside partnership group, and that's gone out and started new relationships with retailer, with banker lenders, right, with other wholesalers as well, to give them the option to use our incentive program. Long story short, that we'll get into more as we go on in this conversation. About a year ago, I don't know, maybe 9 months ago, Jay actually mentioned the name, but John Crawford was the preferred lender of a realtor that I did a deal with, and she had a medium experience with the lender that she actually did the deal with, but she had to use that lender because he was the guy that had access to the program at that point. But when we finished up that deal, she said, "Hey, can you just reach out to John and get his company onboarded so that I can do these deals through him instead? Because I love this program. I just want to use my lender." I said, "All right, give me a minute." And then a lot of minutes later, because corporate and getting things approved, we just 2-3 weeks ago, finally, the Hoper program with DML, and so now they have access to it. And Jay was actually the first one across the entire org to not only do the first but also the second Hoper deal with us. And we closed them last week, and they went super smooth. It was super easy. And we'll get into the details of what the program is, but it's awesome, man.
So how do you spell Hoper?
So I'll be the first one to say it's kind of a funny name. It doesn't read well. It doesn't sound normal.
Right.
But it is what it's called. And it's called Hoper, Hoper, like hope with an R, because the program itself, the participation that the buyers have, is in the Hope for Homeownership program.
Gotcha.
So the goal underneath it all is just like a lot of programs to help buyers out, right? It's to improve the ability to access homeownership to all different types of buyers. But a lot of incentive programs come with heavy restrictions, a bunch of difficulties, impacts to the rate, impacts to refinance, and we are able to, because of how we're structured, avoid a lot of that and get funding to buyers when they need it.
So something that I saw, it referenced, I think it said $16,000 towards cost or down payment. Is that accurate?
It's 3.5% up to $1,000. So a buyer that participates has the opportunity to engage in our research program. Basically, what we want to do is go out and prove through the data that borrowers that are involved in Hoper, that participate in our program, will outperform a regular batch of FHA buyers, that we are able to get them funding and education, right? It's two-pronged. It's not just like, hey, here's some money, we're going to up your rate and like, good luck. It's, hey, why don't we plug up both holes? One is just education. We just don't know what you don't know. Education,
Right.
financial education especially, is so avoided in public education.
Agreed.
And unless you've got a rich uncle that actually likes you, no one's teaching you about money. Like, it's so hard to learn about. And when you're broke, you don't have time to go learn. And so we say, hey, look, let's actually make you sit still for a second. Take 2 courses. One is pre-closing, and it's like basic finance 101. And then the other one that happens post-close is actually an 8-week financial mentorship course, which you check in once a week for 8 weeks, anytime within the first year of ownership, to learn more skills, how to buy down debts, how to snowball those down, how to establish an emergency fund, how to just stacking skills that will help them not just get into a home, but stay in that home for a long time and really attack the default rate on FHA loans. So that education coupled with, hey, we'll also pay you to participate. Just like if I had a foot cream that was supposed to do, like, hey, let me go to see if it makes your foot fall off, right? Like that would be a research study. Luckily, no limbs are at risk at Hoper.
Right.
We're just like, hey, participate in the program. Let us gather the data on how it affects loan performance, and we'll compensate you for your participation. That's what we do.
That's cool.
So there's other elements to it, but that's really the goal and the vision of how the Hoper is structured, and how we're helping buyers.
Okay, so from a lender standpoint, Jay, what do you see pros and cons with the program?
Pros is access. I don't see a whole lot of cons, to be honest
Good.
with you. I've had 2 clients to do it, and we closed both of them last week. And I guess the success story, I'll say, the first one you could, it was a win because that client was able to pay off some tax liens they had. They were super excited. But the second one, they came to me down. They were working with another lender, and I don't know what happened with the other lender. They just said they stopped returning the call. And this client was initially going to go FHA, and they were under contract already.
Okay.
And so I was like, oh, it's usually like red alert. This loan's probably garbage. The lender's not returning the call. So I get in there, look, and I'm like, wait a second, they've got great credit. It's a clean loan. What's the deal? The deal was they lost their down payment. They were going to get a gift from a family member, if I recall. And they were asking about down payment assistance now, which we've got every down payment assistance program out there we have access to. But in Arizona, if you're a lender or probably a customer now, you'll know that they turn on and off the faucet very fast with those interest rates on the DPAs. And right now they've turned the faucet off. So the rate we were looking at within the sevens, this particular client was 7.75. So, and we just got clearance to run with the Hoper program. And what the Hoper program for a lender is, it's a energy, wind and solar program. So it's a HUD energy, wind and solar program that's approved through HUD. And we're approved lender to participate in this program. So what we were able to do is, I lost my train of thought. I was like, I go talking about Hoper.
No, you're good. I mean, I can fill in from there as well, as that this buyer needed access to the funding. And the last piece that we haven't touched on yet is this solar piece that Jay's getting into right now.
Yeah.
A lot of these DPAs, a lot of these assistance programs are going to offer money in exchange for, like, what's the trade-off, right? Like, what are they getting out of it to give you this money? And it's always a way for them to make their money back, either now or when you inevitably, it's like a forgivable in 15, no payment. It's like they know you're going to move out in less than that and get their money back. Plus, like, they know these things. They know how they're going to get their money back. And so there's always added risk to the borrower. What we wanted to do is, how do we find a way to get money into the buyer's hands without impacting their, like, without adding risk, right? Like, what a hard thing to do. And it's kind of a noble mission to go after. How do I actually help a buyer get funding without adding risk? And our founder, his name is Jaron. Amazing dude. And it's kind of fun because I've been in a sales world for a long time. Really, all I've ever done is talk about things and try to get people to do things that I want them to do. When I joined Hoper and I realized that our leader was not a sales guy, he's like a really, really smart mortgage nerd that just wanted to help people. I'm like, okay, like, I can follow this guy to battle. Like, this is awesome. And he said, this is the plan. We can use solar because we can include solar on a mortgage, meaning whatever the purchase price on a home is, let's call it $300,000. We can just include the solar onto that loan. 300 turns into, let's just use a random
Say
number.
350.
Yeah, let's call it $30,000 in solar.
Okay.
So now the loan went from 300 grand to 330 grand. We can just make it go up, and HUD and FHA have a policy that allows us to include it.
Wow.
But when we include the solar and the mortgage payment goes up, what happens to their energy bill? Their energy bill goes down.
Right.
And so we're able to include some of the funding, make some of the numbers work inside of the solar costs, which make mortgage up, energy bill down. I can get you money, but maybe you had a $2,000 mortgage and a $300 power bill. Now you have a $2,200 mortgage and a $100 power bill.
Yeah.
It's like all I've done is move your expenses around instead of give you a new one. And I can do all of that while giving you $13,000. That is so unique. And the way we're able to fund the buyer is through earned income. And the earned income element to what we do makes the program magical compared to these other DPAs, because it's able to be used however they want to. I have regularly 30 or 40% of my buyers don't even need any help. They just wanted the money back. It's like, oh yeah, I had my down payment covered. I don't really have any debts, but like I had 20 grand in the bank and I was only going to have 6 grand when this was done. I'd rather just have more money in my bank account and my expenses don't really change. Or I have ladies, like I had a lady recently who she had her own down payment saved up, but she had about $9,000. And this is similar to the experience we had with Jay, but she had about 9 grand in debts between 2 credit cards and a cruise that she'd financed. And when we paid those off because of how high interest they were, she ended up saving $600 a month by eliminating those debts. Wow. Which is way better than just using the Hoper money to buy rate down or anything else. It's like the impact to her was so significant. And so from a lender side, not to speak for Jay, but what we see from our lenders, what's the benefit from a lender side? It's like a Swiss Army knife tool financially. Because of the earned income label, it can be used against debts, against closing costs, towards reserves. It can be used however they need it to be used without impact to their interest rate. And there's no income restrictions or debt to income limits or any of that. It's just open to everyone.
It's not really a program. It's just it's a approved product that we have through FHA. It's a normal FHA loan, which I love. So as long as it meets, we get a DU approval on FHA, we're good to go. It's nothing outside of the FHA for underwriting guidelines, and they'll allow up to 120%. So when we're doing that, we're doing it as an escrow holdback. So the next question I had as a lender is, oh crap, I don't want to get involved with solar or how's this going to work? And to put it into perspective, Alex said, we got in touch less than probably 3 weeks ago, and I have funded, closed, recorded 2 of my loans already.
That's amazing.
Yeah, and the one that the call that I'm excited about, I called the customer and said, look, we can go DPA and your rate's 7.75, or we can go regular FHA. Seller was paying, in this particular one, like 11 grand, so we had some seller money to play with too. Or we can go FHA. 5.75. I locked him at a 5.75 or 5.875 on a 30-year fixed. Seller paid all the closing costs, but the roof was a mess. And the borrower, it passed appraisal. We got an as is, cool. but there was some concern, and the customer had already gotten some quotes. Alex had the contractors out there literally within 24 hours. We got a bid. It was cheaper than their bid. Long story short, we gave them a whole new roof and solar.
Nice.
What's crazy? I want to comment on that. I want to comment on that because
I'm not done. The total monthly payment was still $200 lower than the down payment assistance one. So when we're looking, I'm like, I can do the DPA all day, but like your payment's still $200 higher because it was a $400,000 loan, and that really adds up.
Yeah.
You drop it a full 2%. We added on this one, I think 47,000, but they got a brand new roof.
Right.
And solar, so then they'll get the benefit of the savings on solar forever.
And 13 grand.
The one thing to note, because if you're sitting there and you're in the industry, and 13 grand is on the solar piece. We the borrower owns it outright. There's no lease payments. So when they go to sell, it's not an issue. It's like they put a pool in. It's just part of the house. The other thing is they are eligible for a streamline. Let's say these rates, we get lucky with the Fed and they cut rates over the next year and they go down a full percent. They can streamline refi. There's no 7-year repay.
Which from a book
there's a
of
lot of that
business
stuff.
perspective, it's like every time you lock a buyer into a DPA, it's like, hey, see you in a while.
Like,
it's like
talk to you in
it's
7
such
years.
it's such a healthier book of business to be like, hey, yeah, let's get you in now, and also, well, let's stay in touch. I might be able to help you out again in 6 to 12 to 18 months. It's like that's so much better for the deals you're doing.
Yeah,
and for the buyer, obviously.
Let me wrap my head around this. So your earned income is what the solar is generating for you?
To an extent. There's legally, and the way that it exists is not that really, right? But there's some overhead. There's the ability we have through managing the solar to be evergreen. And so what's important to understand is what Jay mentioned in the beginning, that these DPAs turn the faucet on and off for when they have money, when they don't. Because of how we fund these projects, we don't have to worry about running out of funding to do another one or to do 50, right? Like we can just keep doing them. And so they earn the earned income through their participation in the Hoper program.
Oh, okay. So that's the class. You did the class.
Exactly. They do the class. They respond to the surveys.
Okay.
They're participating. They're involved in Hoper. And Hoper is who pays them.
Now, as a lender, it's treated as earned income. This is no down payment. It's not a grant or a gift. It's earned income. They'll actually receive a pay stub upon completion of the class. I think they'll get pay stubs along the way, and they'll also receive a 1099. So it is true income that they get.
It's sourceable, all of that.
Okay. So the $13,000 or 3.5% you're talking about, is that what they're earning for using the Hopper program?
Yep. If you say Hopper one more time, I disconnect.
Hoper?
It's Hoper.
I'm sorry, Hoper.
No, I'm just kidding.
Hoper.
My brother works for me, and he still calls it Hopper, and I yell at him every time.
Okay. Well, Hoper. That's unique because I've done in my career. I've done the first time buyer programs, the FHA, the AmeriDream, the Nehemiah programs, all that kind of jazz. I've done a lot of HUD homes with the 203K, 203B. So what I'm kind of getting a sense of, because Jay mentioned 120% loan to value. You're basically using the same kind of product, the 203K or 203B, because you're financing the upgrades. So when I was having the HUD world, if there was no kitchen appliances and it was less than $5,000, that was 2K. If it was over $5,000, then it was 203B, right? I don't remember if it's B or K is properly.
Yeah, no, you're pretty. It's 203K and 203K. 203B is a regular.
Right. Okay.
And
so it's the same.
203K streamline. You have the streamline too. Yeah. But it's very similar. It works very similar. We escrow holdback. And for the lender, for the realtor doesn't even know. The listing agent on this particular deal didn't even know. I called and told him a couple of times. I'm like, hey, FYI, it's this crazy new product I have. We're going to fix the roof and throw solar on after. Believe me when it closes, and it closes. And he was like, that was easy. Send me more about that product. He thought it was pretty cool. Yeah. But like as an agent, it's hands off. As a lender, it's really hands off as well. It's like, okay, get the contractor quotes for a roof if you need a roof, or and the solar bids. Yeah, and then we get that as the lender, and the underwriter throws that into the mortgage. And so
that's the piece I wanted to comment on. Is the roof piece so capital doesn't matter, but I love capital. We have access to a bunch of different installers all over. I mean, I'm not going to share it, but I have on my pricing sheet where I have to make quotes for all over the state. We can do everywhere except for the Dakotas and Alaska, literally. So we're in 47
all the United
states.
So it's okay, cool. Yeah. So even though you're not in the Valley, your program Hopper.
Yep. My program
Hoper.
Hopper.
I'm sorry, Hoper. Damn it!
I thought that was on purpose.
No, but Hoper's nationwide except for the 2 states you said.
Correct. The Dakotas, North and South, and then Alaska.
Okay.
But in this example, right, for this deal, Jay's buyer had a quote for like $7 or $8 grand for like a spray foam, for like a new spray roof, like the white ugly spray roof.
Yeah.
And the shingle roof, he didn't even know it was going to be. It's probably going to be 15 or 16 grand for the full shingle roof.
Sure.
I send the information to literally my main contact over at my installer that I use for most all of my Arizona business. I just text him that day. I'm like, hey man, look, this is the inspection. Also, we didn't even have the inspection yet, and we needed it. So I just called the listing agent. I was like, hey, do you have any inspections, anything from a previous buyer looking at this home? He's like, yeah, I do. I'll send it up. It's like we'll figure it out, right? So got that info.
I got to stop you there because there's a big, and Jay can attest to this. we as realtors don't like sending the lender the inspection report because that usually blows up the deal.
Sure.
But because Jay's not getting it, you're getting it. You can
I
learn
would have
how
never
to.
turned it in. Yeah.
Okay. Well, no, but you get me, right?
Right. Yeah. No. Yeah.
If Hoper requests it, it's fine because you're going to use that concept, the 203KB thing that we referenced, right, to finance whatever repairs are initiated and needed in order to make that house be up to par at closing.
Because they knew there was roof work needed that
Right.
they didn't want to cover. And I was saying, hey, look,
And
we just need to be able to know what needs fixed so I can quote it properly and include it into the loan on their side. You don't have to deal with this in concessions. Like, let me figure it out and price it out. And when we got all the numbers back, we were able to do a full shingle, full re-roof for like 10 grand. It was like $2 or $3 grand more than the original spray roof fix, and included all of that into the solar bid.
Right.
And because his ratios were good, right? The more you add to a loan, the closer you might get on a buyer's ratios.
Yeah.
His were tight at the end, but we were able to make it work and got it done. And it's so cool for him.
That's amazing.
Yeah. Sorry, Jay.
Yeah. Oh, no worries. No worries. Yeah. They were pumped. And as a lender, one nice thing, or the listing agent as a real estate agent, if you've got a house in this case, the appraisal came back as is. So the roof didn't need any repairs per the appraiser.
Sure.
We never got the inspection, but per the appraiser. But had it said subject to roof repairs, it wouldn't have held back our close of escrow because we were doing a, escrow holdback for the roof.
Right.
So took a lot of pressure away from both sides saying, hey, even if it does come back and we need to fix it, we're in the clear. So it's an excellent product for a house that you just, as an agent, you're pretty positive this thing's going to need a new roof.
Yeah. So
and again, asterisk, it's FHA product only. So we're capped up to,
What's the FHA max right now in Arizona?
It's about 546.
Okay. So to ensure there's no fraud, because, all the bad guys look for ways to fraud this program, things like that. So the escrow holdbacks is directly tied to what work has to be done. So once you close escrow, that's when you get the contractors out there. Did they have a certain amount of time they have to complete the work?
Yeah. So it's the FHA solar wind technology policy. Like you can look it up in the FHA. It's a lot of syllables.
Okay.
But
Hold on.
Solar wind technology, SWT.
FHA solar wind technology.
Yeah, type that in.
SWT. It's the DML SWT program.
The FHA solar loan program?
FHA DML SWT acronym program.
So many words. Pull up the policy, the guideline, right?
We're talking about the HUD DML FHA SWT program.
Okay.
You're right.
Okay, hold on. Here's the beautiful thing about what I can do here. I can screen share. So is this the program?
That's something. Let's see. Is that the DML one, or is this a different one?
It looks like marketing from, I'm not sure. I can't see that well. But yeah.
Scroll down, see who this is from. Is this branded to like a lender?
I don't believe so. It's just kind of talking about.
Yeah, it looks nicer than what we see on the HUD website.
Yeah, I wonder if it's branded to like a lender.
Yeah.
Because we can't be advertising like Fairway,
So this one doesn't. I know. I would never do that. I don't want to do. I clicked on it. The first link. No, but legit. The first link was a broken link, and I wasn't going to click there. This doesn't seem to have.
It looks like it though. Yeah, that's just an informational thing. I don't see any.
Yeah, I don't. That's why I'm scrolling slow.
That's fine.
Simply Solar. Okay, this is Simply Solar. It has
your thing you're talking about, $13,000, and then your FHA 3.5%.
Scroll to the very bottom. See whose slide deck this is. But yeah, this is a lender that took our program and created the easy to consume, whatever. Let's see. Oh, it's not even branded. Let's see.
Right here, it's that company.
Yeah, probably just a broker. I actually think Simply Solar might be the loan store. We have a few options for our brokers to fulfill through. But essentially, the program allows us to go up to 120% LTV,
right?
Based on the appraisal, purchase price, or whatever. The requirement is it must be installed within 120 days. It's very clearly written that it does not need to be installed and turned on within 120 days. That's called PTO, permission to operate on a solar system, because that requires the utility to come out and inspect it. And if there are people involved that we don't pay, we can't pay them any better to go any faster. And so we must make sure that it is installed within 120 days. But this example with Capital, with Jay's buyer, the roofer said they would go out and have the roof done within the first 10 days post-closing. So they've probably already got it scheduled. They're going to go bust it out and get that taken care of so that my installers, my solar people, can pull permits and get their system up on the roof as well really quickly. As soon as the system is installed, that's when the system is paid for completely. This probably doesn't matter, but 50% is paid out at closing, and then the other 50% is paid out upon completed installation. And that's really how it works. But most of the time, especially in Arizona, it's within 30 to 45 days that the system's on the roof. The lender will just send an appraiser to do an eyeball inspection that it's actually there, and then it's over. Then we pay it out.
Nice. Okay, that's awesome. And now with solar, obviously, there's going to be a warranty that goes along with the buyer.
Oh
the
yeah,
new homeowner.
All of our installers carry basically the same warranty, which is going to be 25 years on the workmanship, punctures, leaks, broken shingles, whatever. Which like happens in the first week or two when they're like doing the work. Like there's you're gonna know, or the first time it rains, you'll know. But the panels themselves, this is the one that I love the most, is that it's a 25-year, 90% production guarantee, meaning the system cannot degrade more than 10% in 25 years or they have to fix it. Where like iPhone batteries are built to expire in 24 months, so you have to buy a new one. Like that's how technology works now. And they're saying, hey, these will make no less than 90% of what we promised year one during year 25, or we have to fix it. And that's a good peace of mind, because people are like, are better panels going to come out? Isn't there going to be better technology? Like, am I buying too early? It's like, of course. Like the phones we have in 10 years will be cooler than the ones today. But if we know how much power you need today and we make you a good system, your system's going to be good enough for that long. And even if you get a bad batch and your panels crap out in 11 years, great, we'll fix it. Like that's part of how the warranty works. So there's really good peace of mind for everyone involved, the buyer, the realtor, everyone pushing the program. You know that you're getting good warranty.
So Hopper program, it's FHA based. It's approved by HUD. It has to do with solar and wind technology as well. That's the caveat. You earn up to $13,000 or 3.5% income because you're going through the education process from your initial approval into the program all the way to closing, right? And then you're still doing education for the first year while living in the home, right? So that's where that earned income comes from.
Yeah.
And it's an FHA product, which is, Jay, you said the FHA in Arizona is 546.
I'll have to look that up. It's it's changing here. It's about to change, but I think it's 546, 250 if I'm not mistaken.
Okay, so just call it 545 for easy measure.
Yeah.
And then it jives with the FHA rates, which are typically lower than the conventional, which baffles my mind because FHA is a Fannie Mae, Freddie Mac product, right? But it is what it is. So that seems legit. I mean, and have you had a lot of success with this countrywide since you've only been doing it 1 to 2 years? So
what's been cool, and I've been able to have a few experiences similar to what we're doing right now with DML, where we are going out and just working our way up the ladder to speak with corporate at a bunch of awesome, I think the funnest projects for me personally to work on are these little bit smaller retail banks that do in-house lending and getting in front of their 100 to 200 loan officers that are grinders, that are out there working, doing their best to offer good business. It's like a business size that's big enough to have experience to do a great job and small enough to be hungry, as opposed to when you get into these really large, like big national lenders that have thousands of loan officers and it's kind of just cush. You get leads and it just feels different when you're working with people that really care to go out and build, and to have something new to speak to as well is just amazing. Like something I'm working on with Jay is going after refi targets. It's like, let's go after some FHA rate and term refinances and say, hey, buyer, working on getting a list from the last like maybe 24 months of purchases that have over a 675 or over a 70, right?
Okay.
Let's send an email to those buyers. And why doesn't the email say, hey, you're in an awesome position to refinance. We can get your rate down X amount and save you this much. We can also get your electric bill down. We can also put $13,000 cash in your pocket. It's like, what a cool offer, because we can give you this money. There's no closing costs. There's it's all getting rolled in anyways. There's no minimum requirement to come up with on a refinance. It's just like, let's give you money to pay off some debts, pay off your truck that's only got $9,000 left on it, pay off your credit, whatever it is, or just up your reserves I had a teacher recently that we refinanced for that just had no money. And he was so pumped to refinance, drop his mortgage payment by like $250. His power bill also brought down his expenses, and he just pocketed some money to just have because they had $500 in their bank account. It was like,
Okay, so when you do a refi, then you can take advantage of the solar?
you
Like
can
you have a
include
house,
the
you have a
solar
house with
again
okay,
into the
okay,
refinanced amount.
okay.
So
So if
on
you
an
didn't, so if you didn't have a house with solar and you want to refinance, like I have a client that I send to Jay, hey, this guy's FHA, he wants to refi. Then because of the Hoper program, did I say that right?
you got it.
Okay.
Nice.
Then that client then can not only refinance, get a lower rate potentially, but put solar on their house and earn $13,000 in earned income
Correct. That
for a
sounds
refi.
pretty FHA
Wow.
rate and term refinance. We need a fresh appraisal. Off of the appraisal, that'll tell us how much we can add in solar, right? Because it's 120%. It's 20% above appraisal value that we can add.
Yeah. Yeah.
But we never even get close, right? Like on a $400,000 home, we have 80 grand in bandwidth.
Yeah.
We never go above 40, like ever. It's between 30 and 40 every time, unless we're doing roofs like we did with Jay's guy. But they get lower rate, get an asset added to their home, which adds
Yeah.
value, and they own it free and clear, lowering electric costs, and they're pocketing over 10 grand almost every time to do whatever they need to with. And with
That's
usually buying
insane.
off debts has the biggest impact, right?
Yeah.
Paying off a credit
Yeah.
card to save $200. We paid off tax debt on another one with Jay. It's like there's so many cool ways to leverage the money, and even if it's just going to cash reserves, what a
Yeah.
joy to lower.
Yeah.
Even if you refinanced, the rate came down, mortgage down, but solar added, solar makes it go up, and it's like the same thing, but you just have 13 grand in the bank now. Isn't that still just better? Like,
So yeah, we've had this conversation, and at the office, like you asked me, what's the downside, and like right away you're like, oh well, you're forced to get solar. Like, okay, so you're forced to save on your electric bill because it's paid for. Like, there's no lease on it. Like, there's not a lot of downsides. I don't see any really. It's a fantastic property.
if
The,
I
the
were to,
downside is, well, the downside is you finance something into your house much like a pool. Well, the alternative is pay cash. So the
Yeah.
alternative, if you wanted solars, you'd have to come up with 30, 40 grand cash. So to me, as a lender, there's no downside at all. I think it's a fantastic product.
Now, with this solar product that you guys are putting on with this program, is it the type of solar product that you can store the excess energy, or is it stuff that gets fed back to the power
so that's a
supplier?
good question, and it
Thank you.
depends. It depends on the market that you're in. It depends on the utility that you have. So I sleep well at night because I over-explain things to the buyer. So they know
Nice.
exactly what to expect when it comes to how well their solar is going to produce, how much savings they can expect, if they're still going to have a power bill, which the answer is almost every single time, yes, you will still have a power bill.
Sure.
The most important, I'll start backwards. The least important thing I do is save you money on a power bill, because of the impact of the funds at closing almost every time. A lot of times it's the only thing making the deal possible to begin with. And these other DPAs are going to just jack your rate up and raise your expenses $300 without trying to save you $1 anywhere else, right? So even if adding the solar raised your rate $300 a month and we only saved you $100, okay, it's $200 a month more expensive, but I'm in the home and I can refinance whenever I want to.
Yeah.
That's still
No,
better.
it would have never happened because there's no DPA that's offering a rate that's so much lower than FHA. That's likelihood is slim to none.
Yeah.
Right. So you can correct me if I'm wrong on this one, Jay, but the DPA programs, the rate's typically going to be 1% higher. So if it's 575,
Well,
it's
yeah,
usually
even
the
675.
most recent case, it was
Okay.
2%. It's a little bit more.
Okay.
Yeah, 1%
Okay.
at best. At best.
Okay. Yeah. Okay. Yeah. Because
So,
yeah. Okay.
So compared directly to a DPA, because we go mortgage up, power bill down, it's never
Yeah.
even close. Like
Yeah.
it's never even close to being as good as a DPA that comes with 5 to 10 year repayments or the forgivable periods where you can't refinance. It's never even close. Beats the crap out of them. When it comes to just FHA straight up covering your own expenses, it's
Yeah.
still so competitive because it's essentially a wash, right? We're not just raising your expenses, it's up and down and wash plus cash that you can use however you need to. That even if you had everything covered, you can still just find a home for that 13 grand to free up $300, $400, $500 a month in other debt removal, which you
Yeah.
can't do that by buying rate down unless you spend a lot of money buying rate down.
So talk about that a little bit, because a lot of people think, like you say, a lot of realtors, listing agents advertise, seller will, buy your rate down, which, here's $5,000 for rate that buy down, which really doesn't do that much. If you have somebody that wants to buy a rate down, what's on a $500,000 purchase price? They say it's conventional loan, and they want to buy the rate down 1%. What's that going to cost a consumer?
That's probably a Jay. It's probably a Jay question.
Okay, Jay, what's it going to cost, Jay?
They want to buy it down. What do you mean they want to buy it down?
Well, they want to
1%?
say
That's the misconception.
Right. That's why I'm asking the question.
Right?
That's right. That's why I'm asking the question.
People think 1%. I want to buy it down 1%, and they think that means I'm going to go. If the FHA rate right now, let's just say is 6%, they think I'm going to go from 6% down to 5%. Not the case. When you look at the rate sheet, in lender jargon as we speak, if I say, oh, we're gonna buy it down a point or 1%, that's how we talk. 1 point. The first point is typically equivalent to about 1/4 to 3/8 in rate. On a lucky day, maybe you get a half. It really depends on how compressed the margins are, and how aggressive the investors are pricing. Right now, and I would say for the last couple of years, pricing with no points, no origination has been ferocious. It's been, as a lender, you just almost want to gag quoting. So we get in the habit of quoting with one. It's at least a half, if not 3/4 in rate for the first one right now. So, but then after that, it's not a tit for tat. You can't continue to pay 1 point and get 0.5%. So once you get that first hill, it's kind of slow go from there. So, but to answer your question, and in my 30-year experience, 1% typically would be anywhere from 3/8 of a percent to rate to about a half.
How much does that cost?
Sometimes in this market, how much does that cost?
Yeah, cash to do it.
Well, 1% is 1% of the loan amount. So on a $500,000 loan, it's $5,000.
Right.
Yeah.
That's why I asked the question. Yeah. Because so many.
Yeah. So $5,000. So 1% is $5,000. Yeah, exactly. Yeah. So $5,000 seems like, it's going to get you a long ways, but in reality, a lot of times only gets you 1/4 to 3/8 if the pricing is kind of normal. But we're not in normal time. So right now, points are going a little further than they normally do. At least the first one does.
But still not enough to make a significant difference on a monthly mortgage payment, which is why I asked the question, because you see it. I see it all the time when I'm looking at houses to show for clients in the private remarks, the realtor, oh, we're going to, the seller's offering to buy, pay a point at closing. Okay. But really what, like you said, it's 1%. So it's on a $500,000 house. They're going to give you $5,000 to buy down a point, but that's not going to have such a major impact on the mortgage payment.
Went from 6 to 5.75 or 5.60, but what a huge jump. Yeah.
So it'd be better.
Sometimes consumers, they misunderstand that and think it's going down a full 1% in rate, which is not the case. A full 1% in rate, you're not going to usually see on the rate sheet. I'd have to think about that's a huge jump. And you're looking at least the rate sheet kind of cliffs off at about 6 points. So you're willing to pay 6 points. You can buy it down pretty far, but 6 points on a $500,000 loan is $30,000. Yeah.
Right. But that's why I asked the question, because it's everybody that searches houses online, they see that. And they're thinking, oh my gosh, I can get my rate bite down a point. And, the consumer doesn't understand, which is why I asked you that question. Explain it to the world, because then people are going to understand. Take that $5,000 for something else as opposed to buying your rate down. Yeah. And if you use the Hoper program, you get $13,000. The rate's already going to be lower than the conventional product because it's FHA. It's not DPA. It's traditional FHA financing. But then you have the added caveat of adding solar and potential other repairs as needed based on each individual circumstance.
Like I had another one recently.
The lady got it, Chris.
I'm going to go work for Hoper now.
There you go, man. This lady had like $11,000 left on her boat loan, like randomly.
Wow. Yeah.
But it was a big payment. It was about $740 a month. She was making on payments on the boat.
Yeah. So why not?
And she paid off the boat.
Yeah.
Pocketed $2,000, and instead of putting $11,000 or $13,000 towards rate, which would only go so far and save her $100, $150,
right,
she saved $750 on her overall expenses by leveraging the money the best way, which is the beauty of the earned income. It can go anywhere, and you can always find a reason to use it, especially for people that don't just need a little bit of cash to make the deal work. These other people that you're getting into the home, you will get them into the home in a much better position overall by buying down debts or just replenishing reserves. Go ahead, Jay.
So for total transparency, the $13,000 of earned income, that's not given boom at closing, right? You have to do certain steps to get that?
You have to complete the pre-close course, and then the money itself is wired to title the day of closing. So there's a unique mechanic that we use called a savings club account. It is an acceptable source to pull funds to closing. We distribute the money there and it's in their name. But part of why a savings club account is cool is because in order to receive the money, you have to follow the rules of the club. The money is in your name. We can have paid it to you to make it sourceable. Okay. But one of the rules of the club is you have to successfully close on a home to access it. And so once they are closing, we send it to title so they're not buying a jet ski early and messing up the deal. And it kind of protects the money from them a little bit.
But the reason I ask that question is because I know somebody that's going to watch this. Well, wait a minute, when do I get the money? So I like the fact you don't give it to them up front, but I wasn't sure based on our conversation because of the continued education, the post-closing education that you require them to do, if it was something, hey, you're going to get, $7,000 at closing, and then you're going to follow these steps for the first year to
get the full. They get the full amount at close, okay, and then we stay on them to finish the post-closing education.
Okay, afterwards. And I'm assuming nobody's really giving you shit about that.
The hourly rate, if it takes you 3 hours to do the first course and 7 to do the last, and you did 10 hours of work for $13,000, your hourly's pretty good there. So freaking do your class.
That's a great program. So, what are the minimum requirements for somebody to qualify for that?
It's all FHA requirements. Okay. So it's like the 580 credit score. Yep. It's the regular 47, 57 debt to income ratios front and back end, but there's no income requirement. There's no anything. So long as their ratios work, adding solar, right? Like if they're already maxed out and we add the solar and we price them out of the deal, we got to get creative, right? We got to use the money to buy down debts to open up their DTI, or just tell them to look for less home. So if
that's why I put that finger up. I was like, as a lender, it's nice to have $13,000 to pick and choose as we're qualifying, because sometimes it's that car payment that somebody has that's the reason that they can't purchase a home right now, and we can start to finagle and learn, or maybe we pay this off or use it in a different source to get you qualified. So I like having that as a lender as well.
Okay, so I hypothetically, I take somebody out, FHA, first-time home buyer. I get you guys dialed in with them. We find a $500,000 house. They have the 580 FICO score, and they capitalize on this program. There's as long as they follow the minimum requirements, it's a no-brainer. So if I actually get the seller to give me $7,000 in additional closing costs, which I do all the time, now all of a sudden you basically have $20,000 to play with.
Exactly. Yeah, docs are title already, Chris. Thank you.
You're welcome.
That's how fast we are on these deals. No, you're exactly right. Yeah.
Okay, so, and I've never heard anybody explain this. I'm going to ask you this question, Alex. Explain debt to income ratios for FHA.
So Jay is definitely more qualified to explain what they are, but there's going to be a front end and a back end, right? One is all of your debts without housing included. One is all of your debts with housing included.
Okay.
Basically, if you make $10,000 a month in income, you can spend up to $5,700 a month in all of your debts plus your housing, basically, kind of, right? If your mortgage payment when added in was already going to be, all of your payments were going to be $5,700 a month, and then I wanted to add the solar, well, the solar is going to add $200 a month to it. So now you're at $5,900 a month. That's outside of your rate. Can't afford that anymore. But if that buyer was looking at a home and all of their expenses plus their mortgage was only $4,000 a month, oh great, I have plenty of room to add $200 a month in the increased solar payment you're making onto your mortgage. And because of that, like there's no issue there. A lot of DPAs are going to say, hey, instead of $4,700 a month before your housing and $5,700 a month after your housing, we're actually going to limit that because we're adding extra risk. We're going to say you can only go 40%, 50%. So the lower the bar, and you can't access as much home, which is really annoying because you wanted to shop for this type of home in this type of neighborhood, but now because you're using an assistance program, it's limiting all of that. But what we do, because it's just an FHA loan, you have the normal ratios. You have the normal maximum you can look for, which is really enabling.
Yeah.
It's really cool. And if you have enough money for your down payment, but not enough money to pay off debts, well, then let's use the Hoper money to say, right now I'm maxed out. I'm at $5,700 a month. I'm right at the end of my ratios. But if I use the Hoper money to pay off my truck has $9,000 left on it, but it's a $650 payment on my dumb Raptor that I bought. Well, now all of a sudden you're at $5,000 again, and we can easily add $200 a month to your payment by adding the solar. We can absolutely fit you back into the type of home you want after clearing up some debts. So hopefully that's a semi-followable conception of what debt to income is and why it's important that we don't have restrictions added on, and using the Hoper money can help free that up for a lot of buyers.
That's fantastic.
It's an excellent product too. As I'm sitting here, there's so many ways and reasons to use it. If I'm a realtor and I have buyers that are kind of at the very peak end of their comfortability as far as payment, and it's just not opening up doors that they like, it would be worth a conversation and looking at this product and using this 13 grand to see if we can pay some debt off, or shuffle the cards a little bit for you and get you, maybe we can get you a $50,000-$60,000 higher home. And now, with everything being the same, opens things up to the consumer and the agent.
And
it's worth the conversation.
Right, because they can also use it 3.5% as their down payment. Yeah, that's amazing. And so it's down payment assistance without the catch.
Correct.
Right.
We're not supposed to say that, but correct.
I said it though. I can say it.
Yeah.
I say whatever I want. I'm the real estate guy.
As a lender, we're being asked, you'll go out there and sell this as DPA, but it's DPA without the catch.
It is.
All day long. Yeah.
Yeah, we do our best not to market it that way, because the objective under it all is to put these buyers in a better position. And we know from the data, a buyer that comes to the table with their own minimum required investment will just outperform. It's like I take way better care of my truck now than the car my dad bought me in high school, because I had zero skin in the game and I didn't care as much. We all understand when you pay attention. When you pay, it matters a little bit. And so we want to encourage that as much as possible. But there's going to be situations where it needs to be used that way, but we'll likely market it more as down payment replenishment or whatever it is. But that's a way I'm doing it with builders, because we don't want to mess in the realm of interested party contribution as much as possible with builders. But we're having builders market this as down payment replenishment, right? Like as soon as you're done closing, our Hoper program will send you back your down payment. That way we're not involved at closing, IPC, but it's like, finish your deal. We'll just wire you directly afterwards, and it counts as part of their incentive package without happening at closing. That's rad.
That is.
And so there's a lot of cool ways to do it.
Absolutely. Anything else you guys want to talk about?
That's it, man.
It's the Direct Mortgage Replenish Your Down Payment Program.
Yeah.
It's the Direct Mortgage Replenish Your Down Payment Program. Give us a call.
Okay, well, how do people find you, Jay? You got to drop that, man.
My cell phone's always the best way, 602-570-1744. Or you can always go to directmortgageloans.com.
And if people want to research so if people want to research the program, is there a platform online they can do so?
Yeah, well, I find Google's what everyone uses, so that's where I went. What would you say, Alex? I Googled it and found everything I needed to know instantly, much like you did, Chris.
Yeah,
I was surprised, because I thought it was going to be some program that there was very little information. It was a much larger deal than I expected.
Yeah, I mean, so transparently, we have partnered with, dozens of national lenders. So it is becoming more available, but there are a few groups that have done a really good job at not adding in a bunch of annoying overlays. Like our program at its core is really good and really accessible and can work in a bunch of different ways. DML is one of my favorite partners because they haven't been like, hey, also we're going to add 19 extra rules to really limit this for our lenders and for our realtors and for our buyers. And so it's definitely worth, if you're going to consider using the program, look up freaking Jay and connect with us. Like the process with Jay, he said, from a lender perspective, it's really hands off. He said that earlier. You would think it would be way more involved. His entire involvement with me on the deals was, hey, this is the address. Does this work? I'm like, let me figure it out. He's like, cool. I'm going to put you in a text with the buyer, talk to them about the program and get the stuff you need from them. I was then in a group text, took the enrollment call, worked with my processors in the back end, got everything over to his processing team. Didn't even really include him except for he was CC'd on the emails. And then when they went to close, everything was good to go. But the actual involvement from Jay or from any of my LOs on the deal is really little. You send us the buyer. If they're not under contract, we'll just pump them up on the program, get them excited, tell them what to look for in a home. If they are under contract, we'll send them all of our documents, get them a solar bid, sign the solar contract, and then come the day of close, we make sure processing has everything they need. And so it's very clean. We obviously did 2 of these as the first 2 deals for the entire company, within 2 weeks. Like, you would
Start
think
to
it would be
finish 2 weeks. Yeah.
so stressful. Sorry, we don't have the process established. We can't do this. It was like, no, it's like, put this in this box on the closing disclosure, and we're going to send the money to title, and we're good. And that's how it
so
works.
we made a couple errors along the way, but we got it all worked out.
Yeah, we got it all
We
worked out.
disclosed on the CD that the borrower had to come in with $51,000, and I started getting calls and texts.
Yeah, they put the solar on there twice, but we figured that out.
By the way, the final number was like $3,079, so I was very excited. They came in with $3,000 and got a brand new roof, new solar, and the house that they want. Yeah, they were so excited to get. Yeah.
So cool,
last question. I know the answer to it, but again, consumers need to be educated. So it's got to be a single family detached residence, right? We're not doing condos, townhouses, patio homes, unless they're
never condos.
Right.
We can do townhouses, but the easiest way to know is look up the development from aerial view on Google, satellite view on Google, and see, does anybody else in my neighborhood have solar already? Sometimes the HOA owns the roof. Sometimes it does not. It really is pretty 50-50.
Yeah.
But if there are other townhomes in the area with solar, it means that the owner owns the roof instead of the HOA. So that is possible. Condos never work, but single family is the way to go most of the time. But we can even do manufactured homes.
I know. I said patio homes too, because patio homes are typically single level. You own the land, you own the entire structure itself. You may be in an HOA neighborhood, but you're owning. It's like a rectangle patio home. Like, remember those old school shotgun shacks? You open the front door, goes through out the back door. That's a patio home. It's just a single level rectangle, but you own it, right? So that obviously could qualify then. So basically, it has to be owned. You have to be able to own the roof of whatever property you're buying for this program to work.
And then even if it's like, if it's a real mess, but it can go FHA, we can always do ground mount.
Oh.
And so even if there's no like fixing the roof, or they're living there because they're going to build something else on it, it's like, okay, cool, let's throw in a ground mount. That can count as the solar. We can get you your incentive and we can make it
So they have their own solar farm.
Yeah, exactly, man. Exactly.
Right on. All right, cool. This has been a moment with the real estate guy. That's Alex Wilson from Hoper program. That's Jay Ray from Direct Mortgage Lending. You can Google him and find him everywhere. It's a great program for anybody that's looking to purchase FHA homes, right? Because you don't have to be a first timer, correct?
Nope. Anybody looking to purchase or any rate and term refinances.
Right. If you want $13,000 for taking 7 hours of classes, you want to get this program. It's amazing. I'm Chris, I'm the real estate guy. Until next time, see ya. There you go.